Mr. President, do you intend to lift sanctions on Iranian oil, and do you intend to potentially put U.S. troops or more troops in the region?
No, I'm not putting troops anywhere. If I were, I certainly wouldn't tell you, but I'm not putting troops.
President Trump asked us to hold off on future attacks, and we're holding out.
Oil markets are seeing some relief as President Trump and Prime Minister Netanyahu try to ease war worries. Traders scrutinizing every headline with the conflict upending energy supply chains. The IEA calling this the biggest supply disruption in oil market history. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. High energy prices are reviving fears of a global inflation shock. Bond investors worldwide now rushing to price in higher interest rates, complicating the path ahead for central banks. We have a range of market voices from around the world giving their assessment of risk, starting with the Bank of Singapore's global CIO, Jean Chia. Alibaba and Tencent shared around $60 billion in market value in about 24 hours as investors punish China's tech giants for failing to clearly explain how they can profit from AI. Indian billionaire investor Raamdeo Agrawal will join us exclusively on whether he sees a buying opportunity as stocks get hammered by fears of an energy crunch. Our top story today, the leaders of the U.S. and Israel have sought to reassure investors rattled by damage to major Persian Gulf energy facilities. Israel says it will no longer target energy infrastructure after a rebuke from President Trump. And Prime Minister Benjamin Netanyahu says Israeli forces will help the U.S. attempt to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
For more, let's bring in Horizon's Middle East and Africa anchor Jumana Basachi joining us from Dubai. And Jumana, of course, we hear Netanyahu speaking there, probably trying to ease those tensions with President Trump.
Well, that's exactly it. I think, this time yesterday, 24 hours ago, President Trump put up that post distancing himself from Israel's airstrikes on the South Gas power field. Now, that was disputed. There were many reports that emerged subsequently suggesting that the U.S. probably would have been privy to the information that Israel were about to strike that gas field in Iran. But then later on, interesting to hear from the Israeli Prime Minister himself saying that the IDF had acted alone, that not in conjunction with the United States. So at least from that perspective, the U.S. is trying to put a little bit of distance between the actions that Israel took and the subsequent very violent response that we got back from Iran, hitting those key energy infrastructure sites and causing a significant amount of damage to that LNG plant in Qatar. Now, I think one of the questions that people were asking yesterday is whether we're beginning to see a divergence in the war objectives between Israel and the U.S. And that is something that President Trump was asked in the press conference yesterday with the Japanese Prime Minister. And he said, we are still very coordinated, but if the Israeli Prime Minister does something that we don't agree with, then we tell him that. But then later on, the spy chief, Tulsi Gabbard, went to say, maybe give a little bit more detail and suggested that from the U.S.'s perspective, their objectives are centered around the decapitation of Iran's military capabilities, whereas from Israel's perspective, perhaps it is one step further and the real diminishing and leveling a lot of blows at Iranian leadership. So herein, you're getting a bit of a difference in terms of ultimate war objective between the two. And I will just say, from the Iranian standpoint, a post went up yesterday afternoon from the Iranian foreign minister. This is Abbas Araghchi. He said that this time around, they didn't use all of their firepower, but that if energy infrastructure and civil infrastructure gets targeted again, they will unleash full fury. So this was a warning that came through, but also suggested that perhaps this mode of retaliation or this round of retaliation was over for the time being. That's not to say that the strikes haven't stopped, though, because overnight, more incoming drones and missiles being intercepted in Bahrain, in Saudi Arabia, and just a short while ago at the UAE as well.
And Jumana, Qatar Energy weighing the costs, it's estimating $20 billion of lost sales a year.
So pretty notable that they put up a post overnight to the world explaining how much damage had been caused. Yesterday, after the attacks, they did say that quote unquote extensive damage had been sustained. Now they've given a little bit more numbers as the figure. Essentially, 17% of the capacity has been hit. They estimate that it's going to cost up to about $20 billion a year over the next 3 to 5 years to fix. And they also say that there's a real possibility of introducing a force majeure on some of their longer term contracts as well. So this is to really encapsulate how much of a blow was inflicted on those LNG facilities yesterday. And this is different from the situation we were in at the beginning of the war, where Qatar Energy preemptively declared a force majeure because of the disruptions around the Strait of Hormuz, the inability to get their products out to the broader market. This time is different. And as we spoke about yesterday, the market is beginning to center on this idea of physical destruction as opposed to just physical disruption. At the same time, President Trump is still trying to put together a coalition for naval escorts to forcibly reopen up the Strait of Hormuz. But effectively, what we've seen over the last couple of days is it is still pretty much under Iranian control. And the only vessels that are passing through are somehow linked to Iran or Iran linked or heading to destinations that Iran would not deem to be hostile.
Jumana, thank you. Horizon's Middle East and Africa anchor Jumana Basachi for us in Dubai. As Brent prices ease from this week's highs, Asian stocks are stabilizing. Yet the surge in oil prices since the war began has left central banks signaling fresh concerns about an inflation shock. Agrawal Hong joins us now. Of course, we talk about prices easing, but still at 106.
Yeah, I mean, it's pulled back from the highs of around 120 earlier yesterday, right? But this is mostly because of Besson floating the idea that, maybe they'll unsanction some Iranian oil. Then you had soothing soundbites from Trump and Netanyahu. To your point about how prices remain elevated, it's 45% higher on Brent since the conflict began. And that's really fueled this hawkish central bank messaging that we've been seeing this week. Yeah, we heard Powell saying, we just don't know. Lagarde also suggesting that there are downside risks to growth. But you look at what the BOJ said, that flag on oil prices came in really early. The BOE talking about how they stand ready to fight inflation. And suddenly you saw that reaction in the market. Front end gilts. The move was massive on the 2-year, and that dragged up the front end in the US, in Germany as well. So you saw that curve flattening, which puts to question the popular steepener trade for the year. And I think that debate will continue as we continue getting these developments on the conflict. Gold has been really interesting this week. Today, somehow, despite these signs of potential de-escalation, gold is climbing. So it speaks to the sense of, I think, how it's been driven more by the rate cut bets, central bank bets, rather than the haven demand, because it has been coming down in the past couple of weeks.
Agrawal, hang tight. Agrawal is sticking around. Let's get to our guest today, get perspective from Jean Chia, Global CIO at Bank of Singapore. Jean, suffice to say, assumptions have changed 3 weeks into this war.
Yeah, exactly. So as responsible investors, we really had to have a hard look at our own assumptions. Very early on in the year, we started out with a relatively bullish stance, being risk on in equities. So as of last week, 12th of March, we actually made an adjustment to that, just taking into account the fact that we are in the midst of a war and uncertainty is going to be front and center. And as we speak, there are so many moving parts. So we have actually moved an overweight in Asia ex Japan. Granted, we were very early in the game. We had upgraded Asia ex Japan as early as 2024 So with a 40% gain, we were prepared to now move it to a neutral stance. And the rationale here is not so much a risk-off sort of stance, but more of a risk management. So we do think that it's important for us to recognize that in a war, there are variables that are very uncontrolled. And as investors, we shouldn't be reacting headline to headline or day to day, but rather having a strategic sort of allocation to be able to weather this. So to your point, central banks, I think Evo did mention, this is indeed, again, a pivot from the central bank stance, and rightly so, considering that, Powell mentioned wait and see 4 times in his speech.
And when you take a look at the bond
Yes,
market, right,
yes.
I mean, there is a sense that the risk of a stagflation environment is real.
Yeah, so we can't rule that out at the moment, but as we all cannot predict is the duration of the war. So oil price is rather unlike tariffs, because tariffs, on the other hand, the transmission mechanism is multifold. So there are absorbers in the middle, such as your corporates that can absorb that into their margins. Oil is one of those commodities that feeds straight into CPI numbers, as well as consumption. So, I mean, the first order, we know that oil prices will go up. It hits perhaps the feedstock also for manufacturers, and corporates start to get affected. So margins will be eroded. So there'll be winners and losers. There'll be companies that had, done the right thing to focus on supply chain resilience, climate resilience, energy resilience, and countries, for that matter, that are going to be less hurt than others that have perhaps taken a lower oil price for granted. And, that's not to say that that's fully priced in. The third thing, of course, is consumption getting eroded, right? At what point, what is the tipping point where oil price gets to where you start to see demand destruction at the consumption level? And that is the fear now on the stagflationary risks. Again, it's not to be, sort of fear-mongering at this point, but really to take into account now the possibilities and factor in some probabilities into our investment thesis.
Yeah. Which markets do you see as more vulnerable? I mean, Singapore is seen as a bit of a haven, but it's interesting, this past couple of weeks, the script has been flipped because of its exposure, the vulnerabilities from LNG as well.
So I think if we can characterize the entire world, it's a bit, I think we have to acknowledge that everyone will be impacted. The question is to what extent, and then it becomes a relative game. So we all know that the net oil importers will clearly be taking the brunt of higher oil prices first, and that includes Japan, Korea, and then Southeast Asia, clearly with different varying degrees of energy dependency on oil, right? So I think that China, on a relative basis, seems to be less affected. Obviously, a lot of the Iranian oil is China bound, so there is clearly going to be some impact. But to the extent that China has diversified its energy sources to include renewables and multiple sources, I think there is potentially less impact. Not to say that be no impact. Clearly, global demand is going to also impact China in a big way. So I think it's all a relative game now. We're just calibrating between the different markets where some of this is going to be.
And how are you calibrating between onshore and offshore? Do you expect the onshore performance to be more entrenched going forward?
Do you mean
outperformance for China?
Okay, I think it's more at the maybe sector level. So we're actually looking more, not so much onshore, offshore, but more at the corporate resilience, right? I think certain industries, be it more domestically oriented, perhaps would some of the companies that are less dependent on upstream oil. So it's also we also need to be quite conscious of energy sector, because there's the upstream players, downstream players, and it's not homogeneous how high oil prices will impact them. Now we're also talking about supply side. So if there are constraints on the supply side, clearly their production levels will also be affected.
Still in China, Chinese tech have been sold off. We talk about Tencent, Alibaba. The earnings have disappointed because of the lack of ROI to that huge capex. How are you looking at AI plays in China now?
So I think it's expectations management at this point. I think we've all acknowledged that tech, whether it was in US or China or Asia, has had a very good run. So they remain very vulnerable. I think there is concern now also on the supply chain for semiconductors. On top of already the AI disruption fears, we have now got something to worry about upstream as well. So I think it's a recalibration of expectations on the tech sector. Longer term, I think we we remain committed to this sort of structural theme, and I think now the homework has to be done on actual impact. I think investors were also disappointed on maybe not enough of an AI strategy that was articulated. So I think the players will now have to look at communicating that a lot more closely for the year ahead. Yeah.
We will also be continuing to watch the central bank communication, I suppose. Do you still see rate cuts from the Fed this year?
So I think from the beginning of the year, there was expectation from OCBC Group, which is our house view, for one cut for the year, and I think that remains the case. However, I mean, we're also watchful now on the inflation print, because we can almost expect March and April to start to reflect some of these higher prints from an inflation standpoint. So it's also weighing, for example, the timing of the Fed chair and Fed chair transition, and that narrative is also going to play into rate expectations. We think that it's going to be a lot more less of bias towards a rate cut. I mean, we saw in the meeting that there was only one vote in favor of a cut. So I think the narrative is shifting very, very quickly, and we're seeing that in yields. Yeah.
It does sound like some of these other central banks, including the BOE, sound more hawkish than the Fed. I think that is one of the takeaways from this week. What does that mean for the dollar? There had been a bit of a rebound this year. Does that reverse?
So we've held the view of a longer-term view on the dollar, of dollar weakness, and I think the view is more of a structural long-term trend that we are seeing, and that is premised on the fact that fiscal sustainability remains something that investors will need to focus on. And right now, of course, there is the concern over what happens from a recessionary standpoint. So we're not necessarily calling for short-term trading, but more as a portfolio allocator, we want to be conscious of potential weakness in the dollar. So you mentioned gold in some of your remarks. I think gold for us is a strategic asset that we would have in portfolios, irregardless of where the near-term pricing goes day to day. We do think that gold has
a diversifier.
That's right. So I mean, there are many ways to think about gold. Some will say that it's a currency, and therefore, in my mind, it's a non-sovereign currency. And to the extent that its relationship with the other asset class in times of crisis is also very important within the portfolio context.
Jean, you talk about the dollar, probably a weakening trend from here. What would be the currencies to hold right now? Some point to the yuan, even the Malaysian ringgit, as pretty good bets.
I think we've always held the view of Sing dollar as a potential. I think the Sing dollar for us is also a strategic currency, if you like, for many portfolios, not just for a directional play, but again as a foil, if you like, for potentially concentration in US dollar. Not so much directionally, but the fact that a lot of wealth management clients, for example, have a large concentration of US dollar exposures, and therefore some of the diversifiers include gold as well as Singapore dollar. And Sing dollar is special because of the way that the MAS manages the currency, and also, of course, added to that, there are a lot more investment options now in Sing dollar with the equity market, some of the themes in terms of the initiatives that have been put in place by the government. In Asia, I mean, let's just go back to that. I think Asia as a whole, we do think that we're not just looking at country allocation, but also some of the structural themes that are happening in Asia. So, the value up initiatives, these are long-term trends, right? As well as in terms of AI beneficiaries, or that is something that we think, even in the midst of this uncertainty, we need to keep our eye focused on that.
And keep your Sing dollar, Avril. Jean Chia, Global CIO at Bank of Singapore. Still ahead on Insight, tensions over the Iran war are simmering between the US and Japan as President Trump brings up Pearl Harbor during Prime Minister Takaichi's White House visit. Keep it here with us. This is Bloomberg.
We went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? He's asking me, do you believe in surprise? I think much more so than us.
President Trump speaking at the White House as he hosted Japanese Prime Minister Sanae Takaichi. That awkward moment perhaps underscores the tensions that continue to simmer over Trump's push for Japanese assistance in reopening the Strait of Hormuz. Takaichi says she reminded the president about the legal restrictions on Japanese military deployment.
And speaking of the situation in Iran, Iran's development of nuclear weapons must never be allowed. And that is why we, Japan, have been urging them and also reaching out to other partners in the world. In addition, Japan condemns Iran's actions, such as attacking the neighboring region and also the de facto or effective closure of the Strait of Hormuz.
Japan economy and government editor Paul Jackson joins us now from Tokyo. Paul, enough to say that there were several uncomfortable moments. What stood out?
Well, that was certainly the biggest moment of tension, the mention of Pearl Harbor. It hasn't provoked the outrage you might have expected in Japan, partly because the issue of the attack on Pearl Harbor is far less a motive in Japan than it is in the US. I think if Donald Trump had tried to make a joke out of the atomic bombings of Nagasaki or Hiroshima, I think that would have had a very, very different response and could have really tarnished the outcome of these talks. But I think the key takeaway is this is about as good as it gets. I think Prime Minister Takaichi went to Washington under a bit of a cloud. Donald Trump had resorted to his usual tactics ahead of a big set-piece meeting by ramping up the pressure on the other side. There have been these demands to send ships to the Strait of Hormuz, kind of scratching an itch that Donald Trump has had since the 1980s, this irritation that Japan and other neighboring countries such as South Korea, benefit from oil coming out of the Middle East that doesn't actually go to the US, and yet the US pays for the security. So I think this has gone pretty well. I think she's managed to keep the relations cordial and kind of sidestep being put on the spot about what Japan is doing to help the US with this Iran conflict.
Well, Trump was also complimentary. In fact, he did say that Japan was stepping up to the plate. I'm just wondering, for Japan, what really was achieved? I mean, did Takaichi get what she wanted going there?
Well, as I was saying, I think that the key points of her mission here, if you like, there's maybe 3 or 4 things that were in play. First of all, keeping the relations cordial and warm and deepening those. Remember that Donald Trump responds well to personal ties. He had quite good relations with former Prime Minister Shinzo Abe, who Takaichi liberally referred to in their talks and at the dinner later on. So keeping warm personal ties is an important aspect of dealing with the unpredictability of Donald Trump. Avoiding being put on the spot about the ships or assistance to the Strait of Hormuz, another key point. And I think getting reassurance on the strength of the alliance in Asia between Japan and the US, and also the idea that Donald Trump will put in a word for Japan when he meets Xi in China.
We have to leave it there. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on shares of Alibaba after the Chinese tech giant reported third-quarter sales that missed estimates. Sluggish growth in its core e-commerce business dragged on earnings, while intensified competition in food delivery also crimped profits. Alibaba's cloud and AI unit saw the fastest growth. The company says it aims to quintuple revenue from those businesses in 5 years to $100 billion annually. Well, Bloomberg Intelligence thinks that Alibaba's margins will be limited as it accelerates AI expansion. Senior analyst Catherine Lim and Robert Lee are with us for more. Kat, let's talk about investors seem to be more concerned about how Baba is faring in its core retail business than AI.
Yes, there's a lot that's actually going on for Alibaba itself.
And really, I think the 2% missed when it comes to e-commerce really leaves people wondering, whether the company is in a position to actually monetize out of all the things that it's doing. To give credit to the company, the Quint integration into Taobao only took place in January, so it's not reflected in this set of results. That's going to be the next set of results that I'm actually looking for to see whether, you're going to see some form of upticks, in terms of the revenue growth. And it's good actually hearing from the company yesterday that there was a weak cyclical issue when it comes to consumption in China in December itself. So that dragged on their entire, transaction activity. It has picked up over the last 2 months, and clearly Lunar New Year does help as well. So, the bets are now on third quarter. But again, I think the reality is that we're not going to see, the margins uptick because there's still a lot of the subsidies and the overall consumption in China isn't as robust as what it used to be.
That's right. Consumption remains an issue for the economy. Rob, Alibaba targeting $100 billion in AI revenue in 5 years. What's your assessment of that ambition? We've been talking about monetization. We've been talking about ROI. How does this play into all of that?
Okay, well, yeah, again, that's a very punchy target. Whether they'll get fully there or not remains to be seen. But again, the question is, at what cost? And specifically, I'm talking about CapEx. They didn't update on their CapEx guidance last night, but clearly CapEx will be going up substantially in order to drive that sort of top-line growth. And also, there's the big question about margins and ROI, because if you look at the adjusted EBIT margin in their cloud intelligence business, as reported last night, that was 9%. That compares poorly with their US peers, someone like Amazon Web Services, generating operating margins of about 35%. That reflects the hyper-competitive nature of China's market, more fragmented market, and the very heavy levels of subsidization that are going into cloud at the moment. So if you looked at the cloud business in cash terms, so again, look at the revenue, the margin, and then take into account the very, very heavy CapEx cost, that is a loss-making business in cash terms. So the ROI is not there. Same goes for Tencent, and I think that's one major reason why you saw both stocks sell off. But as Catherine said, the core of Alibaba's business is e-commerce. That's the main driver of their earnings going forward, not AI.
And of course, Kat talked about agentic commerce. I mean, what does it mean for Baba's competitiveness versus the likes of Tencent?
Well, we all adore Alibaba's ecosystem, whether it's the Taobao, the Fliggies, the AMAP out there. They've got what I would say Douyin doesn't have right now, as well as, what Tencent at this point in time doesn't have because, they didn't start off, with that e-commerce and that entire, shoppers who are willing to actually spend. But the reality is that even with this early lead, anything can happen over the next couple of months. And as Rob has mentioned, it is such a highly competitive market in China that, this is the big question and $1 million question really out there for anyone who wants to actually bet on AI in China.
And Rob, do you still view Baba and Tencent as the potential long-term winners in China's AI sector?
Very briefly, can I go back and answer that question? How does Alibaba differentiate itself from the competition? Because agentic AI is being rolled out by everyone. OpenClaw is an open source product. Literally every company that I look at in the China tech space is integrating OpenClaw. So maybe Alibaba has some very brief lead, but the technical barrier to entry is not there. The level of commoditization on the AI side is immense. So again, how will Alibaba or any of them develop a sustainable competitive edge in AI? I just don't see how that will happen. And again, that also, I think, reflects in the share price reaction. You have to remind me of your question. Sorry.
Do you still view Baba and Tencent as a potential long-term winners?
Well, again, okay, right. In any commoditized business, of which, again, there's clear evidence is the case in China AI, Just give you a data point, more than 750 large language models in the country. That's a phenomenal amount of models that the industry is in oversupply. So again, in common with any commoditized sector, scale ultimately wins out. So I think given their massive financial resources, their massive developer resources, I think Alibaba and Tencent are very well placed to emerge as the long-term winners. But again, the key question is, how are they going to develop a return on investment? And in cash terms, AI for both these businesses is loss-making. So again, that is, the penny's beginning to drop with investors. This is sucking up cash. There's no timeline or visibility on when those returns will come through in a meaningful way.
Right.
So therefore, the winner of this is the consumer. The winner is potentially productivity in the Chinese economy. It's not the shareholders of these companies.
Bloomberg Intelligence senior analysts Catherine Lim and Robert Lee. Well, our next guest expects China's leading internet companies to see downward earnings revisions in the near term. Let's get insights from Vivian Lin Thurston, portfolio manager at William Blair Investment Management. Why are you expecting that, Vivian?
Yeah, very clearly that both companies are facing the pressure both on the core business front and also future investment for AI-related technological developments. And I would say the leading e-commerce company facing even more structural kind of a pressure on its core e-commerce and quick commerce business. And the continuous investment in light of the structural increase, intensified competition will continue to weigh on their profitability and also the earnings in the near future. The other question or the pressure is coming from the AI race. That's already in full throttle in China. And interestingly, that we know China, every industry in China tends to quickly come into the evolution phase. And I think AI probably, even though we're still early innings of that development, but we already see the competition heat up quite substantially. That means every single player, whether you're leading or not, you will continue to plow in more money and spending to further support that advancement.
Vivian, we heard from Rob earlier about how the likes of Alibaba and Tencent have failed to articulate their vision on how to make that money. Is it just a matter of that inability to articulate? Eventually, investors might just be surprised that, that vision will come through. They will make that money.
Yeah, I think it's not surprising. I think most companies out there don't know what is the best path forward at this point for monetization. So I'm not surprised that both companies couldn't articulate this very well at this stage. And I would say on the positive side that it's very natural for such a disrupted industry in such an early phase of adoption. And when the application can be so broad and so deep and so long lasting, but we don't know yet. So I think as the technology continues to evolve, the applications and the related monetization models will become clearer. So whether it's through cloud, whether it's through infrastructure, whether it's through some hardware developments, I think one way or the other, we will see that monetization coming through. And then China specifically, as they've done that in the past on mobile technology and internet technology, I think what China is best at is to continue to advance those technology, but more importantly, apply that to this 1.4 billion very digital savvy population. And that powerful combination can really lead to pretty strong, I would say, potential monetization outcome for Chinese companies. But we're not there yet. But I do think eventually, probably the industry can get better idea about that path.
Vivian, it's not just Alibaba and Tencent that have been punished this week. Chinese tech in particular as a whole have been sold off. What do you think markets are pricing in by doing that?
Yeah, we are in a very complex and complicated phase of investment, if you will. So in addition to all the fundamental developments we just talked about, I do think the backdrop of Chinese equities and emerging markets equities are very complex. And one of the key reasons is the recent Middle East conflict. That definitely lead to potentially high increased inflation in different countries, given the surging oil prices and natural gas prices. So high inflation tend to be bad case for emerging markets, given that it will really pushing up a lot of potential interest rate environment and also reduced real purchasing power. And on top of that, military conflicts in history tend to lead to risk-off mentality for global investors. And the risk assets such as emerging markets equities or Chinese equities tend to be penalized as a result. So not surprisingly that we see Chinese equities recently, along with some emerging markets equities, perform quite volatilely and also not as strong as we expected.
And in terms of valuations, are they looking attractive enough if you're a longer-term investor?
I think it depends, right? Versus its all recent histories, emerging markets equities have re-rated, and Chinese equities, same thing, and which is justified given that earnings have also improved quite tremendously, whether driven by AI technology or industrialization, continue kind of growth in terms of exports. However, if we compare that versus developed markets, I think that delta is still there, or discount still there. Whether on the technological side of the opportunity sets or broadly speaking for emerging markets equity or Chinese equities, the valuation discount is still there versus the US or developed markets. So from that end, I do think valuation isn't a big issue on the high level for Chinese equities or emerging markets equities. But regardless, I think fundamentals need to come through given that inherently Chinese equities or emerging markets equities have higher risks, as I mentioned earlier.
Right. Yeah, but are there parts of Chinese tech which still have solid fundamentals that investors are not quite acknowledging?
Yeah, I do think if you look at individual companies and industries, certain companies in China still hold up very well. And for example, some of the AI tech-driven, more the ecosystem hardware tech companies, and also recently some energy transition companies, ESS or EV battery companies, and some of the industrial companies continue to do very well because the earnings are still very solid and the outlook remains quite strong. And most of those kind of drivers are coming from the strong exports of China across different industries and also technological advancement. One thing I think is for certain is China's pursuit for AI development is unwavering. And I do think China will continue to push forward and even decouple from the rest of the world. If we are seeing some of maybe the hiccups in the US or the developed market front in terms of AI capex cycle, I do think China could continue to plow forward and then using that as the opportunity to further set them apart away from the rest of the world.
If you were to take a look at the risk-reward profile of the Chinese market, how does it stand versus ASEAN, India, Latin America?
Oh, that's a very, very different, all very different. So I would say compared to India, everything else equal, I would say Chinese macro backdrop is slightly more favorable. As especially recently, as the oil price continued to rise as a result of the Iran war, India equities are under a lot of pressure because they are net oil importer and they really rely on oil for their energy source. Therefore, you see the currency, Indian rupee, really weakened, and then that will take a little more impact on the country, both on the growth and also equity front. And China somewhat insulated from that, given that oil is only about 1/4 of their total energy source, even though China is net importer on oil. So other 75% still domestically sourced from coal, hydropower, and also alternative energy. So with that, China, you can see their currency being actually strengthening, quite resilient. But China has its own problem, which we've been seeing for some time, which is domestically, you still see the deflationary pressure, weak consumption, all that. And that's to some extent, it will be here for some time, given that property markets and all that. But the brighter spots are the exports and also technological driven kind of growth. So this kind of tale of two cities have been playing for some time for China. And I'm envisioning this will continue to be the case. So net-net, I think China probably will be better off in the near term on an aggregate basis compared to India, given the Middle East backdrop. Yeah, and then ASEAN Depends. Yeah, depends on different countries. Yeah.
Right. Let me just follow up on that. I mean, China's looking at a lower growth environment going forward from here. Are there sectors within the country that will continue to do well despite a low growth environment?
Yes. So low growth is domestic growth is really low. But if you look at the export growth has been quite strong and continue to hold up very well, above 5-6%. And partially is China in this new phase structurally in the so-called global industrialization phase. Meaning previously, China tried to industrialize domestically from the manufacturing front. They really advanced their capabilities and the scale, all that. Now they're getting out to rest of the world. And then used to be more developed markets focused. Now they're going all over the world, Latin America, Africa, Middle East, and all that. So that really provides that kind of additional growth driver, not impacted by the domestic weak deflation and pressure. So I think that has been China's kind of a strategy in recent years. And until they sorted out the domestic consumption issue or the property market issue, I think they will continue to push forward on the export front.
U.S.-China tensions continue even though they're trying to reset their relationship. I'm just wondering, is that tension reshaping the way global investors allocate capital, in the coming years?
Yeah. I mean, the U.S.-China relations being in this strategic competitors or rivalry status since actually second half 2018, when the first trade war between the U.S. and China started. So I would say this is structural, nothing really new. And incrementally, I would say actually now, I would say the relationship actually more benign or predictable, even though the trade conversation negotiation continues. But compared to other priorities out of a U.S. national security concern, whether it's Middle East, whether it's Ukraine war issue, I feel China probably not as a top priority right now from the national security concern perspective. However, the structural constraint, restriction, and also the trade pressure will continue, but that's manageable. And China has been dealing with that quite well. As the data show that even with all the trade war, China gross export to the rest of the world continue to push new record high. Right. I guess eventually, as long as China continue to provide high quality, high technology, and low cost products across become more and more cutting edge kind of categories, the rest of the world will need China for that.
Vivian, thank you so much for that. Vivian Lin Thurston, Portfolio Manager at William Blair Investment Management. Now, something here to alert you to, the Indian rupee falling to yet another new lows. That new low is 92.91 versus the USD. Even though we're seeing an easing in oil prices, that's still not enough. We have oil, Brent, in excess of $100 a barrel, putting a lot of pressure on the economy of India, which imports almost all of its oil needs. Again, the Indian rupee testing a new low at this point in time, 93 versus the USD. That's a level it is fast approaching. Still to come, why the Goldilocks moment may be over for Indian growth as the war in Iran triggers soaring energy costs and supply chain chaos. We game out the potential scenarios with Bloomberg Economics. This is Bloomberg. Welcome back. You're watching Insight. Let's do a check on Indian markets, which have been trading for about 6 minutes now. We have the benchmarks there in positive territory along with the rest of Asia. The Sensex currently up by 1.2%. The Nifty Index, along with the Nifty 100, also in positive territory. We're keeping an eye on HDFC Bank. The unexpected resignation of the bank's chair wiped out $7 billion of the lender's market value. Is currently trading down by 6%. The RBI has since issued a rare defense of the bank, describing it as a systematically important lender with sound financials, professionally run, it says, in terms of its board and competent management team. Still not enough to put the bank in positive trading today. It is down about 6.5%. Now, staying with India, A setback for the country's Goldilocks growth story. The Iran war is pushing up energy costs and disrupting key shipping lanes, risks that could outweigh the recent boost from lower U.S. tariffs. Bloomberg Economics has run the numbers under 3 oil price scenarios. Joining us now from Mumbai, senior India economist Abhishek Gupta. Abhishek, how has the war-linked oil stock broken India's Goldilocks economy?
Hi, Haslinda. So if we go back to the February RBI policy review, the minutes of that policy statement show that 2 of the 6 committee members were seeing scope for further rate cuts. They had noted that India's inflation remains subdued, India's growth is resilient at about 7% or so, but this is the moment we should now start on focusing on sort of inching up towards 8% growth, and policy could be more supportive towards that goal. By the end of February, on 28th February, the Iran war broke out, and that's sent an energy shock, not just an oil price shock, but also a supply constraint shock for India. India depends on 88% of its oil consumption needs for imports, 50% of its natural gas, and 65% of its LPG cooking gas requirements. So that's a big shock for India, and that poses stagflation risks for the economy. I say stagflation risks, and not India is not currently in a stagflation scenario because it's starting off from a pretty solid base, macroeconomic base. So the risks are clearly there, and India's Goldilocks moments needs to be over, but we really need to see how long the war continues.
Your base case still shows growth at about 7% in fiscal 27, but downside risks look pretty significant. What are the key transmission channels through which higher oil is hitting India's growth?
We basically need to understand how oil prices get transmitted to the Indian economy. So currently, oil prices are being absorbed by oil marketing companies. The oil marketing companies have largely absorbed all of the oil price shock so far, and our sense is that they will continue to absorb this price shock at least until the end of the state election cycle on May 4th. Typically, a $10 increase in oil prices translates into a 6% increase in domestic oil prices. And according to RBI estimates, every $10 increase in oil prices hits India's growth by 0.15 basis points. So depending on who absorbs this oil price shock, whether it's oil marketing companies or the government by increasing subsidies, or whether this is getting passed on to the consumers, that really determines the price, the impact on growth.
Abhishek Gupta, Bloomberg Economics senior India economist. Thank you for that. Still to come, exclusive views on India's markets with Raamdeo Agrawal, chairman and co-founder of Motilal Oswal Financial Services. This is Bloomberg.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict what, none of us can predict what it will be, but it is a very volatile situation. So I would caution really against getting ahead of that position, which is we held this time.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
Welcome back. You're still watching Insight. That was Bank of England Governor Andrew Bailey and ECB President Christine Lagarde talking about whether they see inflation risks from the ongoing war in Iran. The leaders of the US and Israel have sought to reassure investors rattled by damage to major Persian Gulf energy facilities. Israel says it will no longer target energy infrastructure after a rebuke from President Trump. And Prime Minister Benjamin Netanyahu says Israeli forces will help the US attempt to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
Let's bring in Bloomberg Energy reporter Dan Mator. Dan, we heard from Netanyahu saying that they will attempt to reopen the Strait of Hormuz, but it remains shut, and this remains the biggest supply disruption in oil's history.
Yeah, the strait is shut, and perhaps more importantly now, after yesterday's fever pitch of activities, we have a bunch of critical energy infrastructure around the Persian Gulf that's damaged, and so even now, if the strait reopens, which is a big if, we're looking at months and in some cases up to 5 years before some of this energy that really powers the world is going to get back to normal. So what has been up until this point a sort of day by day, week by week kind of situation has now become a real long-term concern for energy users worldwide.
The big question is where oil prices are headed. Brent at 105 right now, down from 120. What are you hearing about where prices might be heading?
Yeah, until the Strait of Hormuz reopens, I think it's going to be real difficult for Brent to take a real strong downward turn. I mean, clearly, coming back off of the intraday highs of yesterday, we're at a much calmer market right now. But long term, until people actually see ships start to flow through there and barrels start to leave the Middle East, it's going to be real tough to see a meaningful turn down. And if we want to see a turn up, all we need to do is go back to the kind of activity we had yesterday.
And Dan, we talked about the damage. We have Qatar Energy estimating that it will come to a loss of $20 billion in sales every single year. Talk to us about the extent of the damage we've seen so far as a result of this war in Iran.
Yeah, so Qatar Energy runs the Ras Laffan LNG export facility. It's the largest single facility in the world. It supplies about 1/5 of the world's LNG. And 2 of the 14 trains there were severely damaged in the Iranian strikes yesterday. And so the Qatar Energy is saying that they might have to put a force majeure on production out of those trains for 5 years. So, I mean, it sounds like they're going to have to almost rebuild them from scratch. So it's really, really extensive, severe damage that's going to leave the world. I mean, we thought going into 2026 that there was going to be an excess of LNG in the market, which would have lowered prices and helped out countries from India to Pakistan with cheaper prices. Now we're seeing a shortage in the market this year after learning that those trains will be off for the rest of the year. And so now, wait for higher prices for longer, which is going to be better. It's going to push inflation higher and be really, really damaging to some emerging market economies.
Bloomberg Energy reporter Dan Mator there. Thank you. Meanwhile, Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are now putting that reputation under pressure. Bloomberg Originals has been investigating how Dubai's model of stability is being challenged. Here's a preview.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead. We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
And subscribers can watch that full documentary now on the terminal or on our website, Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. Well, our next guest is based in Dubai and has more than 15 years of experience in global markets and macroeconomic trends. Let's bring in Noureldeen Hammoury, Chief Market Strategist at Equiti Group. Noureldeen, good to have you with us. I know that you're marking Eid today. First of all, 3 weeks into the war, what is the sentiment in the markets? What's being priced in?
Good morning, and thank you for having me. But at least for the time being, what's priced in is like the conflict is still ongoing, and that at least there's no any kind of diplomatic solution, or even in the back scenes. Markets are still in fear, and in addition to that, if you look at what happened yesterday, when the U.S. 10-year yields reached 4.3%, while gold on the other side, we did crash about 6% in gold and silver, plus a higher dollar. This is what's priced in basically a very complex environment where markets believe that stagflation risk is now much higher than it used to be before the war. I believe before the war, maybe the expectations for a possible stagflation was about 40%. Now we're well above probably 50%. And if this continues more than, I would say, 4 to 6 weeks, this will be one of maybe the biggest risks that we're watching next.
When you take a look at the price action in the bond market in particular, Noureldeen, it does seem like assumptions have changed when it comes to expectations and risk of stagflation. How is that market pricing that into their own respective scenarios?
It's even hard to pinpoint what the market is basically expecting for the longer run, but at least for the short term. Now, from the Federal Reserve, when expectations were pointing to 2 rate cuts during the previous decision, and now we're the dot plot basically showing only 1 rate cut. Data is not showing sort of the Federal Reserve will be able to cut. Maybe even if you look at the Fed funds futures today, there's no expectations for rate cuts. In fact, the entire sentiment has shifted almost entirely, even across Europe, even in Japan, for a rate hike. And that was not basically the case about like 2-3 weeks ago. Now, one of the main things also that we're keeping an eye on, if the 10-year yields basically continues above 4.3%, that would be one of the main risks to keep an eye on. Yesterday, we believe also that might be some sort of like an intervention, whether if it was an actual intervention to keep yields to keep yields lower, but this is a little bit maybe early to talk about. But verbal interventions are more likely to try and calm the markets as much as possible, and they've been very successful, at least for the time being. But I hope this will continue. Other than that, we need a diplomatic solution in order to bring back at least some sort of safety to the market.
The question is duration, how long this war will persist, and also the impact of higher oil prices. The Fed seems to suggest that the oil shock will be transitory. Do you agree? Could the Fed be wrong?
I mean, I don't like the word transitory, because the last time we used the word transitory during right after COVID, then the inflation increase was transitory, and then it exploded, and we had to deal with it. So I think, at least for the time being, yes, we can say it's transitory, depending on how long the conflict is going to continue. That's from one side. Another side, we have to look at the damage that multiple of the GCC countries announced when it comes to infrastructure. For example, Qatar LNG now lost about 17% of their production, and the time that they need to fix basically what was damaged, it's going to take between 3 to 5 years. That is not something that you would like to see, especially that there's only 14, if I'm not mistaken, there's 14 trains, and now they lost 2 of them. So I think it would be transitory if this conflict ends today. And if it continues more than that, we have another complex environment that we have to deal with.
Brent prices have stayed elevated above $100 a barrel for some time now. How long do you think oil will have to stay at these levels for the Fed to consider tightening?
I mean, I think if we continue to trade above $100 for the next maybe 6 weeks, that would be something the Federal Reserve will have to deal with. Because if you look at also the data that were announced during this week, we had the PPI data, 3.9% when you talk about the core PPI year over year. The inflation target is 2%, and we're nowhere near that 2% since COVID. Yes, we did some sort of, or we had some progress over the past year, but the stickiness of it is still very concerning. And now add to that, you have the inflation from the possible inflation from oil. This is not going to help the Federal Reserve that much. So I think even Jerome Powell stated that if there's no progress on inflation, there is no rate cuts, and they might have to raise rates. I think the possibility of raising rates this year is still minimal. But if things continues more than, I would say, more than 2 months, the Federal Reserve will have to act.
You touched on Treasury yields earlier. 2-year yields have risen significantly, especially in Europe, moderately in the U.S. How much higher can yields go before growth comes into focus?
The only thing that is the problem currently right now, it's more of depending on the duration of the war, much more what the investors feel. Higher rates, as everybody knows, is negative for equities, valuations, and particularly for growth stocks that rely on discounted future cash flows. We should expect at least, I would say, multiple compressions across the market. On the bond side, also, while higher yields create more volatility, they also make fixed income much more attractive from an income perspective. But the long end of the curve may face pressure from term premiums. But overall, bonds, I think, are now offering a much better, I would say, cushion than they did a few years back.
What's the sense you're getting from the equities markets when you take a look at the U.S. in particular? That seems pretty resilient. Elsewhere in the world, not so. How do you play equities right now?
I think they're resilient because of the conflicting and contradicting messages from the White House or from the U.S. administration regarding the conflict. Because at the beginning it was a few days, and then now we're talking about a few weeks. They asked for help in the Strait of Hormuz to reopen it, and then NATO decided to stay away. The White House, of course, pushed back. We never asked for help. We will never need help. So I think currently, right now, the resilience is basically just because of the verbal interventions that we're seeing from the administrations. Now, for how long this resilience continues, I mean, we saw yesterday, at least. We tried yesterday another verbal intervention, but this time it was from the other side, saying the war might end sooner than investors think. But is that actually the truth or the right angle for the time being? It could be, but we're not seeing any kind of diplomatic pressure or any sort of hints for negotiations. So this won't last for long. Verbal interventions, as you know, for many years, it just work on the short term, not on the long term. If they can hold it this far, yes, but otherwise, I think markets will be in another wave of pressure for the next couple of weeks.
So what's that playbook? How do you play defense in an environment where there's still so much uncertainty?
We'll have to. We're very selective going forward, even from before the beginning of the war. But at the same time, there's a lot of opportunities. I mean, especially in the GCC now, when you look at the local markets here, even in Dubai, some of the real estate stocks declines notably, which basically that's what we'd like to see in order to start basically selecting some of the stocks. So, I mean, for example, without mentioning any kind of, it's not like a recommendation, but when you look at the real estate such as Ammar, which went down by about 17%, you had also Al-Dar about 30%. From the banking sector, such as Emirates MBD, we had a decline of 27%. These are the names, at least in the Middle East, that we're looking at least for the short term. Right. In the U.S., we're very selective currently because, again, we're in a very complex environment. The Federal Reserve is stuck. Not only the Federal Reserve, maybe almost the entire central banking system now are stuck between: do we fight inflation or do we fight growth? Because again, the idea of stagflation or the risk of stagflation is much higher than ever before.
Noureldeen, do you think the Iran war is changing the way investors look at the Middle Eastern market?
I mean, especially in the GCC, yes, could be, but at the same time, they were able to. I mean, I'm in the UAE. I'm going on with my day-to-day life normally. Yes, we get alerts every now and then. But I wouldn't say like daily. I mean, I think yesterday there was just only one alert, while at the beginning of the war there was multiple. But I don't see it like that it would change the sentiment or the safety of these countries, at least not on the short term, not on the long term. And yeah, we've seen a couple of maybe videos on social media circulating that with some sort of like negative feeling about the UAE. While the majority, if you look further, today is the first day of Eid, and most likely I'll be posting on social media on how life is basically going on normally for the majority and everybody. Yes, there's maybe most of the people would like to work from home, but it's also most of the offices and the entire country is open. Whoever wants to work from home, they can work from home. Whoever wants to come to the office and continue to work normally, they're also welcome. So I don't think so the sentiment changes too much. I believe with what they've done over the past 3 weeks with this war would make them at least in a much better shape after the war ends, because they were able to handle it. And again, from the government data, more than 95% of the attacks were basically defended without any cost and without any harm.
Great perspective there, Noureldeen. Thank you so much for that. Noureldeen Al-Hammoury of Equiti Group. Still ahead on Inside, AI on the battlefield and the trading floor, how asset managers and investors are using new tools to stress test scenarios and anticipate ripple effects as the Iran war rattles markets. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and this is one currency that's been trying to find a floor and not finding one. The Indian rupee dropping to yet another record low, now dropping to 93 to the dollar for the very first time. We know that traders have been telling us that the RBI has been supporting the currency, selling dollars to support the rupee, which fell, of course, to a record low on Friday. And yet again today, the Indian rupee 93 to the dollar for the very first time. Now, meanwhile, the Iran war is the first global conflict where artificial intelligence is being widely used, but it's not just the armed forces that are turning to AI. Traders are also using it to stress test scenarios and anticipate ripple effects from the war on different asset classes. Let's get more with Ruth Carson, our chief correspondent for FX and rates in Asia. Well, it is about ChatGPT, about Claude. What can't they do, right?
Take your pick, Haslinda. Traders, whether you are a hedge fund, a long-only fund, a research analyst, everyone is turning to LLMs. Everyone is firing up their AI bots to figure out everything from, in the thick of the conflict, what's being impacted, to getting information, packaged up in an incredibly concise way within seconds. And this is having a massive impact to investment processes across the globe. Suddenly, within seconds, information is given to you when previously, say in 2022, it would have taken you hours, if not days. And not only is it speeding up investment processes, we're witnessing history in many, many aspects, because this is the first war that is being fought with AI, and traders are relying on AI itself to figure out what's going on.
It is about speed, but it's also about accuracy. I mean, nothing beats experience, nothing beats knowledge. And in the end, it does depend on the knowledge of the traders to make that call.
Absolutely. And I think that's an incredibly critical point to make. AI is your most powerful research assistant out there, but it's not bulletproof. And that's what all the investors that we spoke with said. You know, it's so powerful, but it does not replace human judgment, and it cannot. Maybe, who knows, you know, this conversation 3 years or 5 years from now, things might be different, but right at this point in time, no, there are still flaws. We know that AI has made mistakes with gaming. You know, policymakers have warned that AI can produce herd behavior, for example, in investors. So it does come down to the trader to make the call.
In the long term, though, Ruth, you've got to imagine the kind of impact AI will have in the investment community and the way they trade.
Absolutely. And I think this is something that's being grappled with across trading desks from Singapore to Tokyo to London to New York. Everyone is incredibly excited with what AI can do. But will it replace jobs? We know it was just 3-4 weeks ago when, you know, people were caught up in AI fear. Now, what does this mean for investing going forward? We know it's not going away. AI as a tool is not going away. It's what traders do with it. And that's up for debate.
Ruth, thank you so much for that. Fascinating. Our chief correspondent for FX and rates in Asia, Ruth Carson there, still to come. As Indian equities regain some ground after their worst single-day fall in nearly 2 years, we'll get market insights exclusively with billionaire investor Raamdeo Agrawal. You don't want to miss this. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on Indian stocks, which are rebounding after Thursday's heavy sell-off. The Nifty slumped over 3% yesterday, closing at its lowest in nearly a year. For more, let's bring in Bloomberg's Manika Doshi in Mumbai. Manika, it's hard for Indian stocks at this point in time, just trying to find that floor.
Well, absolutely. This was, several months ago, an overvalued market, and now we're seeing the full wrath of several collective issues play out on this market. As you pointed out, we've had in the past the AI impact, and now more recently war, higher energy prices, all of that weighing on Indian stocks. Now, I think there are a couple of points to make here. Some of the most valuable sectors in this market, even sectors that foreign financial institutions are most heavily invested in, have all each had their distinct problems. So like I said, IT has been bearing the brunt of AI for the last several months. Consumption, where the recovery was moderate, now is being impacted by fears of an inflation pass-through because of higher energy prices and what that means for overall consumer confidence in the country. And then finally, you've got banks or financial institutions, again, a sector that draws a vast number of foreign financial institutional investors. And just as of yesterday, we had a new governance crisis of sorts with what went down with HDFC Bank. So distinct challenges on all of this. We're about 10% lower on the year, which is a good place to maybe start considering buying stocks, except no one knows how long this war will go on for and how much further prices will fall.
Exactly. Manika, stick around. Joining us exclusively now is market veteran and billionaire investor Raamdeo Agrawal. He's chairman and co-founder of Motilal Oswal Financial Services, one of India's biggest brokerages. Good to have you with us. You've been one of the biggest bulls in India, but here we are, the market experiencing one of its worst times in about 3 decades. How can you remain upbeat about the Indian market?
Yeah. Hi, good morning. Actually, when you talk about 3 decades, I think this is the 4th time market is in a major correction, or you can say even mini crash kind of situation. We saw it in first big one was 60% correction in 92, then 50% correction in 2000, another 50-60% correction in 2008, and recently in COVID we had 30-35% correction. So I would say this is not as severe as GFC 2008 and all. But more recently, what we saw in COVID, it is that kind of a correction. It's geopolitical. I mean, nobody knows what is going to be the length and extent of this global damage. But I think the markets have responded, and at least Indian market, which has become a little more expensive in recent past, has become kind of a little more fairly valued, I would say, at current prices of about 23,000 around Nifty. We are at reasonably priced. Year on year, we are still flat. 12 months basis, we are not gone any lower. So I would think that, yes, there could be some more correction, but we have now clearly reached investable point. I would say market is very fairly valued right now.
Raamdeo, what would you be buying? What's looking attractive then?
Now values are all over. I mean, it depends on what's your view on India and what you would like to be. Banks are very prominent here. They're largest profit contributor to the Nifty, and they are in last 40 years they were never in this kind of shape, and they are growing at about 14-15% at an aggregate level. But there are banks which are growing at 25-30%, and they are available at less than one-time growth. So the peg is less than one. Balance sheet is clean. Net NPA cycle is also kind of at their best. So I would think that you should start with the bank, and then your whole lot of automotive is the one which is seeing massive resurgence. So there are sector after sector, and the main point is that now the broad market is kind of reasonably priced. Growth is all over there because we are growing at about 7.5-8%. So the corporate earnings growth are going to be about anywhere between 10 to 12% for the next 12 months. So yes, we have this thing, challenging spot in tech, which was one of the darling of the market. So that's the one thing which I have no idea whether AI looks to be in the short run a headwind, but in the long run, I think they are the guys who are going to deliver AI solutions to all the corporates all over the world. So I would think that they have long-term future. Short-term, there are some challenges.
So you're saying that the Indian subway companies, that sell-off is overdone?
Not overdone, I would say, but it is done in the sense that one round of see, I mean, if you see long-term averages, if we are available at 20p, our earnings are still looking good despite this war. I mean, yes, it has done some damage, but I still don't think that earnings will be. It will get some hit, but say if it was growing at 12%, it might come to 7-8%. That's the situation right now. But if things really go to $150 or something like that, I don't think market needs to correct even more.
A lot of these software companies have operations overseas, and they will be impacted by the currency. The Indian rupee today marking yet another record low, breaching 93. It is at 93 for the first time ever. How do you think, the weakness in the currency will factor into the outlook for these companies?
Yes. So this currency thing is a double-edged sword. I mean, for the exporters, it is a kind of a boon. And for importers, it's a big challenge. So we have very large importers and all kinds of supply chain is into the global markets. And hence, even domestic consumption has an impact of currency devaluation. So I think it will be inflationary. And to that extent, even corporate profits will be challenged in the short run. But one is hoping that this entire, this geopolitical crisis is somewhat more temporary in character. Maybe it may last for 3-4 months. That's the belief in the market. But if actually goes and stays at $125+, I think we have to rethink entire corporate profits, how the inflation goes, how the corporate profits build up, who are the winners, who are the losers. I mean, that's a different calculation altogether.
Raamdeo, hi, this is Menaka in the Mumbai office. Since we're talking sectors, I wanted to get your view on banking. I know you just expressed a fairly positive view on banking, but what's your take on what went down with HDFC Bank yesterday and that sudden exit of its chairman?
Yeah, I mean, it's as surprising. I mean, this is supposed to be the best governed bank, actually. And they're the people who set the standards in the market. I mean, banking valuation starts from HDFC Bank. So clearly, particularly for private sector, they were the kind of a torchbearer. And now this chairman resigning, and there is no explicit, I mean, even with the con call and all, we were trying to figure out what actually happened. So I don't think in public the knowledge is that much. It's very unfortunate what happened. So the bank has been passing through some kind of a challenge after the merger of HDFC and HDFC Bank and transition. I think the bigger problem is the leadership transition from Aditya Puri and his team to the new set of people, and that too at the time when the merger and all these complications there. So I think this is a phase in which the brilliant institution available today, large unpopular company, I would say, and I would think that the way Indian economy is likely to grow at 7-8%, I think there will be fair share for HDFC Bank to perform, particularly if there is no managerial problem, in the sense that there is no problem with the governance, there's no problem with the balance sheet, P&L, NPA. I mean, those are typical things in a lender's book you would like to you suspect in this kind of situation. But I'm hoping that this credibility of the top management is restored very quickly. But you can get these banks at 15, 16 multiples. I talk about last 12 months at this point of time. So I would think that I would be batting for HDFC Bank rather than going against.
All right. I think the other two sectors I wanted to talk to you about were consumption and infrastructure. There is concern now that there was already a very moderate recovery, and through energy prices, inflation might pose a new headwind for consumption. Again, a set of stocks reasonably overvalued or expensive, some might say. How do you view that?
Yeah, the consumption pickup. See, whatever consumption was interest sensitive, like things like automotive, it came back like the very moment, like in September, they gave the GST cut from 28 to 18, which is, I would think, India is one of the biggest tax reform or tax giveaway in my knowledge. So it was across the board, and the impact of that is very clearly visible in the pickup in the consumption. Automotives are growing almost at 25% in volume terms. So you look at the insurance, where they have cut the GST from 18 to 0%. There, the growth is more like 35-40%. So I think there are a lot of resurgence in this thing, and this is still a market which is growing at about 9-10%, 11% in terms of nominal, 7-8% real, and there are sectors which are growing at least 1.5-2 times of the GDP growth rate. So there is a lot of opportunity for corporates to invest, and well-managed corporates will be able to grow at about their earnings at about 15%. So as the index has corrected to 20%, 20 times multiple, I would think that these are times when the value seekers, those who have the value style of investing, for them it's a terrific time to start building the portfolio and have some patience for the bottoms to be formed.
Raamdeo, on consumption, do you feel like the GST gains that might have accrued to the sector will now get neutralized by whatever energy pass-through we may see over the next few months in terms of inflation, making it tougher for any kind of uptick in sales to sort of sustain over a period of time?
Clearly, Menka, I mean, the supply chain cost increase. I mean, everywhere that packaging, the transport, the logistic cost, everything goes up, and it starts building up N-1, N-2, N-3, and finally it comes to the consumer. So clearly government is trying to take as much blow as possible by not transferring it in the fuel prices and things like that. But industrial side, I don't think government can do anything. It will be mark to market. And if the war gets prolonged, then clearly it will take away a lot of benefits of tax concession which has been given in September. So yes, you're right on that count.
I also want to ask about your continuing interest in infrastructure. It has been a vibrant sector over the last few years, but again here, commodity inflation passing through to companies like cement or sectors like cement, and also an element of maybe overvaluation playing out there. Are you still significantly bullish on infrastructure?
Yeah, long term, the gap between India and the rest of the world is the infrastructure. So infrastructure spend will be as big as what government can afford with the tax collections. So I think as a tax collection is going to be more like 12 to 14% compounded on local currency terms, I think we'll keep seeing more than fair share of money going to the infrastructure. So you have to be bullish on infrastructure for many decades to come. Forget about next year or something like that. But the short-term challenge of the inflationary pressure coming because of this geopolitical situation, that's what allows you to buy the stocks at low prices. I mean, at more lower prices, like say L&T or some other stock, they're down 20-30%. I think they have more than more than taken care of the current challenge on the external front. But I mean, I'm saying that it has probably priced for $110, $115 of oil. But if it were to go to 125, 130, I think we don't know. I mean, how much more it will damage to the earnings.
Raamdeo, you talk about infrastructure. India increasingly wants to be an AI hub. How do you play that AI ambition in India through infrastructure plays?
Yeah, so I think in India we don't have direct play on technology. We are more user and user of the AI and for individual, for the corporates and for the clients. So I think there is no direct play on AI in India, as far as I know. There are small companies and most of them are unlisted space. But what I see is that a lot of finance banks, they are saying that their credit costs, I mean, the way they, one of the companies where we have invested is a digital lending company. So they are able to use, first thing is the cost of the technology is coming down. Second, they're becoming far more smarter in lending. So the credit cost, which was say 3%, that would come down to 2% with the help of AI. So the AI is being used here in India as a much more smartly than actually providing AI as a technology to the world. So that's a fundamental gap. So we will be slow to use. I mean, actually we will be fast to adopt, but it will be visible in the cost and the earnings as we go forward.
Raamdeo, you're renowned for identifying 100 beggars. I'm just wondering, could you share with us which companies actually have the DNA?
Yeah, so that's what I'm saying, that if you see the next 15, 20 years, at least, I mean, for compounding, you need, for a big compounders, you need few decades, not years. So if you see 2 decades or 2.5 decades of India, we are going to go from, say, $4 trillion of GDP now to more like 16, 17, $20 trillion by 2042 or 45. And in that phase, it's one of the most compounded economies. That's what I think one has to understand when one compares one with Korea or Hang Seng or many other regional markets, emerging markets. This is one very smooth 7-8% growing economy, and you can compound it into the next 20-30 years because per capita GDP is still less than $3,000. So even to catch up with the global average of 10, 12,000, 14,000, I think that will require more like 25 years of 7-8% of growth. So, and what is required to grow at 7-8%, that's all in place, and we have demonstrated that we grow it like that. So like banks, I mean, you cannot grow any economy without having a growth rate of plus 3-4% to the nominal GDP. If nominal GDP is growing at about 11%, you are talking about 13 to 14, 15% compounded growth in the credit, and hence you'll get a lot of lenders, small, mid, large, and in EIB era, even large lenders, they can grow at about 15-17%, and the stocks can grow at about 20-22%. But if you buy a mid-sized successful lender, I think it can grow at 25-30%. So that's the kind of opportunity. If you can do stocks you can grow your stock at 25% for 20 years, you're talking about 100 bagger. So that's the kind of possibilities there. We don't have to break our head to find some completely unknown, unearning kind of a situation. There are simple things available in the marketplace.
Sure. Raamdeo, I have a quick final question to continue with Haslinda's theme on style of investing. You're a value investor. Are prices looking attractive enough for you right now to jump in, both hands, both feet, maybe even with some leverage? Or are you expecting that there could be more downside to these prices? The median constituent data from Bloomberg Intelligence finds is at about 35% cut, which is lower than previous falls. So I'm just curious, are you waiting for prices to fall further before you're all in, or is this a good time?
Menka, one of the things is that I'm always all in. So that's the thing. But right now, actually, when I'm meeting the companies, I meet about 4-5 companies every day on one count or other. I'm actually finding values. Yesterday, I came across a company which is actually growing at 25%, but available at 12p multiple TTM. So, the guy doesn't know whether he should pay dividend or not. That kind of company, and good size. So I'm seeing values emerging in the market, and that's a good sign for the markets to bottom out. I mean, who knows the bottom? I mean, only fools and liars know the bottom. So I would not bet too much on whether when the market is going to go to bottom. It has corrected very well. The economy is on the upswing. Earnings are on the upswing. Yes, we have a global challenge. Okay, we'll have 6 more months of patience. I mean, I buy at 100 and it goes to 90 or 80. That's fine. But I'm buying a deep value, and my deep value is valuation below growth rates. I mean, if the growth rates of the company demonstrated and likely is about 20%, 25%, if I can get it anywhere between 15 to 20, 25 P, I think I'm pretty happy.
Raamdeo Agrawal, Chairman and co-founder of Motilal Oswal Financial Services, and of course our very own Maneka Doshi. Thank you for that. Still to come, Seoul gears up for a massive comeback concert by superstar boy band BTS. More than 250,000 fans are expected for Saturday's show, kicking off an 82-date world tour that could out-earn even Taylor Swift. More in a moment. This is Bloomberg. Welcome back. You're watching Insight. Shares of Korea's hype in focus today following the release of the comeback album for its superstar K-pop group BTS. The boy band then kicks off an 82-show world tour tomorrow evening with a free performance in Seoul, lucky them, that could draw more than 250,000 fans to the heart of the city. Errol is back for more on this. I mean, this is 4 years in the making. It is significant. It is huge.
I mean, not to mention how excited the reporters and producers in the newsroom are about this comeback, right? Huge, as you say. If you follow the group, you'll know they've been on this 4-year hiatus. They've been serving the military. So this is the first time they're back as a full group for the performance. And indeed, if you look towards tomorrow, where there's going to be a full free concert, that's really what's getting everybody excited. But the top of this hour, they also dropped an album, Arirang, right? I haven't heard it yet, but I'm sure it's great. And I think what's significant also about this concert that's going to be held in the heart of Seoul tomorrow evening, on top of it kind of kicking off their 82-show world tour, it's also the significance of the location. This is going to be in the heart of Seoul, Gwanghwamun Square, near the palace, and this is an area where there's a lot of historical significance, an iconic landmark. I think it's BTS's way of kind of signaling not just, hey, we're back, but also how they're connecting their local roots with their global influence. And just to give you a sense of the scale of the potential turnout, I think some estimates put it at 260,000 people at least. And I think that area of Seoul hasn't seen a turnout of more than 200,000 in an outdoor crowd since the early 2000s at a couple of World Cup events. So it's massive.
You talk about Arirang, you got to wonder whether Arirang will do as well as Dynamite or Butter, for that matter, because those are really the top 5 among the top 5 songs of BTS. In terms of earnings, what can be expected? I mean, people make comparisons with Taylor Swift Eras tour.
Yeah, I think for Taylor Swift, if you recall, at the time, it was already record and groundbreaking, right? Her takings were like $2 billion. That was a marathon, 150 shows over, I think it was a year and a half. The comparisons being made this time around to BTS's takings, the windfall that could come in from Hybe, which is, of course, the company that manages them. I think Bloomberg estimates put it at about 800 million for ticket, merch, sales as well. But you also have some of these local brokerage firms, more generous estimates. They expect something like $2 billion. And partly because how ticket prices have climbed over the years. So this is going to be quite something.
I mean, you said it's going to be huge. The turnout is, what, 260,000 or so? I mean, authorities are not taking any chances,
No,
right?
I mean, there's also some sensitivities with regards to crowd control, right? Because of the Itaewon Halloween stampede in 2022, where more than 150 people were killed. So, as you say, authorities are really not taking any chances. They're tightening security. Special police units have been deployed. You're seeing restricted access in some of these areas near the event venue. And I guess if you don't want to be part of the crowd, just braving the crowd in Seoul, you can watch it online, actually. Netflix is going to be streaming this event. Some people have talked about it as potentially going to be the most watched live stream of all time.
Come back for BTS, Avril Hong. Thank you so much for that. Well, before we go, here's a look at one of our guests for next week. On Monday, we'll talk exclusively to EFG International CEO about the company, business outlook after the Swiss private bank recently saw Moody's change its outlook to negative from stable. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.